Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates. Very important video for you today because last week the market closed surprisingly strong, right? After we got that huge blowout jobs report of 528,000 jobs created last month, the market only closed down 0.16%, which was really surprising because that's one half of the answer that leads us to believe that the Fed is going to have to continue to raise rates very aggressively, right? If the Fed cannot bring down moderate the jobs market, bring down inflation, then it's going to have to continue to raise rates. And that would fly in the face of why stocks have been jumping so high over the past month. Stocks are up 13% just in the past month because investors think the Fed is going to be able to slow down its interest rate increases. So that really went in the face of that, and yet the market was still very strong. And it's really because corporate earnings from companies have been so strong. The second quarter earnings season is all but over. About 87% of the companies in the S&P 500 have reported already, and we've seen 6.7% earnings growth on a year-over-year basis for the second quarter, which is still lowest since Q4 of 2020, but is still much better than was feared. A lot of investors were hoping or were thinking the worst of earnings. And we got so much better than that. So investors have really been cheering those earnings and driving up stock prices, right? The problem is earnings are not nearly as strong as we thought. I was looking at some research that I'll share with you last week, and it points to really the fact that one sector of the economy has been holding up earnings. In fact, if we remove this sector, then earnings just fall apart. And the consequence of that is that once this sector stops supporting the economy and stops supporting stocks, earnings fall apart. Investor mood just crashes once again, and we could be back into that bear market. So I want to get to that, but stick around after that because we'll be having our Monday market update after that. Monday, 9 a.m., just before the market opens every week. We're giving you all the trends, the strategies, the stocks I'm watching for that week, everything to watch, get you ready for the week. I also want to highlight our Just One Stock series. We just started this series a couple of weeks ago. If you could invest in just one stock across various themes in the market, what would be the one stock that you need in your portfolio? Covered blue chips last week, including one stock that's up over 605% return over the last 20 years. Amazing return there. We've covered value stocks. We've covered index funds. This week we're going to be covering ETFs, so you got to get caught up with that. I'll leave a link to the blue chip stock video in the description below. Make sure you check that out and get caught up. I do want to get to that idea that stocks are not nearly as strong as we might have thought, and earnings are much lower than we were led to believe. 75% of the companies in the S&P 500 have actually beaten their earnings expectations, but before you get too excited about that number, that is actually below what it usually is. Okay, 77% of the companies reporting on average over the last 5 years usually beat earnings expectations, right? And that's just because the game companies play, right? Management comes out during earnings releases, they lower their expectations for future quarters, right? They say, hey, we beat our earnings this quarter, the future doesn't look so bright, so I want to kind of guide those expectations lower. And of course, that just makes it so much easier for them to beat those expectations on earnings in the future and justify their $1 million paychecks. But 75% did beat their earnings expectations. We actually saw growth of 6.7% in corporate earnings over the year from the second quarter of last year to the second quarter of this year. And that's the April, May, and June quarter. Okay, so first quarter is January, February, March. Second quarter is April, May, and June. Those 3 months, 6.7% earnings growth for corporate America over the last year. And that would actually be the lowest earnings growth since Q4, since the last quarter of 2020, right? So not great, but investors were expecting the worst. They were fearing the worst because of the slowdown, because the economy is contracting, is going into a recession. They thought earnings were going to be much lower. So they've really cheered the news and have driven stocks up 13%. But it might not be quite as positive as you think. Okay, if you look closer, you look at all 11 sectors of the economy, the overall average is skewed by just one sector. Just one group of stocks in the stock market is skewing that 6.7% average higher. If you take that out, that one sector, and we're going to look at some data here, we're going to look at what that is. If you take that out, earnings in the S&P 500, so the broad stock market index, actually fell 3.7%. Okay, 3.7% lower earnings than a year ago. That would match up with data that we got on GDP, on the economy just last week, that said we are in a recession. Okay, we've had 2 quarters, so the first full half of the year, the economy contracted, the economy fell, and if you look at this data that we're gonna see, that's gonna back that up and say that yes, we are in a recession. Corporate America is losing profitability. Consumers are pulling back. They're losing jobs, and the economy is contracting. And the standout sector was energy. Okay, we're looking here at the Factset Earnings Insight. If you go to Google, you type in Factset, so FACTSET Earnings Insight, you're going to see their weekly report here that they put out. All you out there in the nation know this is one of my favorite research tools. They survey analyst estimates, they survey company reports, and they put it all together for some great charts and some great research for you for the stock market. And what this is showing here is the S&P 500 earnings growth in the second quarter. So those 3 months of the year that were just reported as far as earnings, how much, what the earnings were for all 11 sectors of the economy. So you see here across the bottom are all 11 sectors of the economy plus the S&P 500. So the all of them together in that broad stock market index. And these are the 11 sectors that go into that. You've got energy, you've got industrials, materials, real estate, healthcare, technology, consumer staples, utilities, communication services, consumer discretionary, and financials. All those 11 sectors of the economy. And what you see here is obvious. Okay, the profits. So this is the profits reported for those 3 months for stocks in those sectors. The profits for energy would just dwarf everything else. In fact, it makes the rest of this graph really hard to look at because the bars are so low. But energy alone had a 299% earnings growth over the second quarter versus the quarter before that, the quarter 1 year before that, the second quarter of 2021. Okay, profits at energy companies in the S&P 500 were up almost 300% over that year from Q2 2021 to Q2 2022. And in fact, if you do look through here, these sectors by sector, you do see that 5 sectors of the economy, all the stocks, the average of the stocks, the companies in those sectors reported losing money. Okay, reported an earnings decline of about 3.7%. If you take out energy, you see. So consumer staples earnings actually fell almost 0.9% lower than what they were a year before. Utilities 1.5%, almost 1.5% lower than a year before. Communication services, and this is all your telecom companies, this is your internet, a lot of your internet companies, this is your social media companies. Communication services reported 13.5% earnings lower, loss, earnings loss of 13.5% across that sector. Of course, this is all the Facebooks, the Twitter, the Pinterest that have really seen their revenues fall apart on the ad spending, the lower ad spending. Companies are just spending less money on advertising online, and it's really coming through in these social media stocks. So all the stocks in the communication services sector saw their earnings fall 13.5% over the year to through the second quarter. Consumer discretionary 18.2% lower. Okay, the retail names, the things that we don't necessarily need to buy, but we do. It's a lot of your car makers, your clothes retailers, things like that. Electronics down 18% from the year before. And then financials here, this last one, down 24.5%. Okay, a huge drop off in earnings of the financials, banks, insurance companies, asset managers, things like that. Now, some things to think about here. I can kind of write off the 24.5% decrease in earnings in financials because we know a lot of those are moving earnings from the income statement into those loan loss reserves on the balance sheet. So they're not really losses, they're not really earnings losses, but they're just cash set aside just in case defaults go higher and we do head into a recession. So earnings were bad in the financials, in the bank stocks, but not quite as bad as we think. Now, the declines in the consumer discretionary companies, though, is very much more worrying. Okay, we saw that 18% decline in earnings for consumer discretionary, for those retailers, for those cars, for the things that we buy but we don't need them. Well, when we start heading into a recession and people get worried, they pull back on their spending. Consumer spending is still 2/3 of the economy. So if consumers are pulling back, to that extent that we see in those profits, in that profit decline, then that is a really bad sign for the economy. Now we're going to get to how to invest in this, but two bright spots here that I do want to point out, and we'll look at other data to back this up. But you see here, all the way over to the left next to energy are industrials and materials. So the companies in industrials and materials, and I'm going to show you how to find the stocks within each of these in a little bit. But both of the stocks in the industrials and the materials sector did actually quite well. Industrials companies, so a lot of your manufacturers there, reported 27% earnings growth over the quarter or over the year. Materials reported 13% earnings growth over the in the 3 months to the second quarter versus the year before. So very strong earnings growth in those. And what we've seen, because the stocks in the industrials and the materials sector have fallen so far this year, stocks in the industrial sector are down 9%. Stocks in the materials sector were down 15% because the earnings are growing so much faster and the prices are coming down on those sectors. Both sectors are in very good valuation territory. Okay, the lower stock prices. So if you're looking at something like a PE ratio, which here we're looking at the sector level forward 12-month PE ratios. So the PE ratios for on average for all the stocks in each sector. So if the price goes down, that P, but the earnings comes up, then that lowers the PE ratio, makes those stocks more attractive on a valuation basis. And we can see that here with these two industrials here in the middle. Now this dark blue bar is the current PE ratio for stocks in that sector. Okay, and then the green bar is the 10-year average. So it's really a way to compare where stocks are valued right now on that PE basis compared to their historical average to see kind of if they're cheap or expensive compared to history. And if we look here, industrials right now trading for 17.6 times on that PE basis, just a little bit above the 17.4 long-term average. So you see the dark blue bar is just slightly above the green bar here. Not necessarily cheap, but not expensive either. Now, if we look over here at materials, materials did very well on earnings. Materials down 15% so far this year. Earnings growth of 13% in the quarter, so very much stronger than the rest of the market. And that sector, so the stocks in the materials sector, you've got a lot of your miners, you've got a lot of your chemical makers trading for 13.6 times on a PE basis. Okay, and that is well under the 16.2 times average over the last 10 years. So very, very attractive valuations there in the materials sector. A couple of other these we can point out here, financials. So you got those bank stocks, you got those insurance companies, things like that, trading for 12.1 times on a price to earnings basis versus 13 times price to earnings average over the last 10 years. So financials, those bank stocks that we've been watching over the past 6 months, really getting attractive right now. Energy is a little skewed here because the earnings have been so crazy lately, but those are still trading fairly attractively here on a PE basis. We've also got things like communication services. So again, those telecom companies, the social media stocks, internet stocks, things like that, trading at about 16.1 times price to earnings, just a little bit above the 15.9 times average. So communication services is also fairly valued, not cheap, but not expensive either. Healthcare, 16.2% right now versus 15.7% long-term average. So a little bit more expensive than the long-term average, but not too badly so. We look at if we look at the market as a whole, so S&P 500, so the 500 largest companies in the United States, that broad stock market index, trading for 17.5 times PE ratio right now. Okay, and that is above the 17 times 10-year average. So stocks after that 13% run in stocks over the last month, stocks are no longer cheap. Okay, stocks are trading just above their 10-year average. They're no longer cheap. They're not necessarily expensive like they were last year, but they aren't those great value stocks we saw. Now, some of the more expensive sectors, we'll cover those before we talk a little bit more about how to invest in all this. But the consumer discretionary sector still trading for 27 times on that PE basis versus 22 times average over the last 10 years. So you see that dark blue bar is quite a bit above the 10-year average here. We also see that in technology. Even though technology stocks have come down this year, they're still trading pretty expensive, 22.5 times on a PE basis versus a 10-year average of 18.3 times. So we've got those most expensive categories here: consumer discretionary, technology, consumer staples, and utilities. So how do you take this? How do you take this idea that stocks are not nearly as strong as we thought? Earnings are not nearly as strong as we were led to believe. And how do you invest with that? Now, it's telling me that this third and fourth quarter earnings, so the rest of the year earnings, might be lower than expected. If we go into those earnings and we see that energy is no longer propelling the stock market earnings up higher, no longer skewing the rest of the market higher, then we could see the truth come out in those earnings. We could see that the earnings at corporate America, the earnings across the S&P 500 are much weaker than we expected, and of course that would be negative for investor sentiment. Stocks would likely fall on that. That combined with the very strong jobs number we got on Friday, 528,000 jobs added, of course. That still says we are in a very strong labor market. Wage increases in that report were up 5.2% on a year-over-year basis. So very strong wage increases fueling that idea of inflation, fueling consumer spending and inflation. And that combined with the CPI, the Consumer Price Index that we're going to see later this week on Wednesday, if that is high as well and higher than expected, then the Fed will have no choice but to continue to increase interest rates very aggressively and really slow down the economy, which is going to hurt those earnings even further. That means that, again, we could be just in a bear market rally over this last month. It could be that supreme head fake before we head on to lower lows in the stock market. How I'm investing, to really taking advantage of this last month, of these higher prices, to take some of those profits, cover some of my stocks with covered calls, and really take some of that risk off of the table before we do head into maybe lower lows and a worsening market. I'm positioning back into those safety sectors, the value sectors that we've been looking at, like banks, like financials, some of the safety sectors like utilities, consumer staples, as well as those other value sectors that we just looked at, like industrials and materials.